Welcome back to the Longacres Finance channel. Today I want to share with you what I think may be the 3 best dividend growth stocks from the September 2021 high growth dividend watchlist. What makes these 3 dividend growth stocks the best is that I think they have the potential to offer the highest total return in the future. There are certainly other methods than total return to determine which stock is the best. You could use historical performance. You could also look at past growth rates or current valuation. And while I do care how a stock has performed in the past and its valuation, I am more concerned with where the stock is headed and whether I would like to tag along on that journey. Making future return assumptions is not a perfect science, and there is a lot of room for error here. I'll share my full thought process with you here, and you can interpret it however you see fit. Up first, we have Mastercard, ticker symbol MA. Mastercard has increased its revenue at a rate of 10.68% during the past decade, with 9 out of 10 years seeing growth. Bottom line growth has been even more impressive, with EPS growing at 16.13% during the past decade. Mastercard pays an annual dividend of $1.76. That equates to about a 0.5% dividend yield, based on the stock's current share price. The dividend payment was bumped by 10% earlier this year. That was a historically low increase for Mastercard. The 5-year dividend growth rate has averaged north of 20%. While such high growth rates are difficult to sustain indefinitely, I think we can expect strong double-digit dividend growth from this stock in the near future. Mastercard has a very low payout ratio that hovers in the 20 to 30% range, leaving plenty of room for future increases. Mastercard has never been a dividend stock for investors seeking high yield. Its dividend yield has not even come close to hitting 1% at any point during the last decade. But what the stock lacks in yield, it makes up for in growth. The 10-year yield on cost for Mastercard is right around 5.5%, which is a pretty solid yield to go along with high total returns. 2020 has been a rough year for the stock, as it is down 2.65% through month-end August. However, Mastercard has rewarded long-term investors with very strong total returns. Its 3-year annualized return is 17.72%, and an even more impressive 29.83% during the last 5 years. Based on dividend yield theory, Mastercard looks to be about 8% overvalued right now. But even with this slight overvaluation, I think the stock is poised to reward investors with strong returns. Analysts are forecasting 27.3% EPS growth for Mastercard over the next 5 years. There is a long-term correlation between earnings growth and total return. Stocks that have been able to grow their earnings quicker have also seen better total returns. So if we assume the share price will follow the same growth trajectory as the earnings growth forecast, and we adjust for the overvaluation and the current dividend yield, we come up with an expected annual growth rate of 26.26%. Now, do I think the stock can actually achieve this return? I think it's possible, but to say 1 year from now it'll be up 26% is a little foolish. Looking out further to the next 5 years, I think it's a little safer to assume investors can receive a 20% plus annualized return. For me personally, that would be a great return. I would actually be content with the 10% annual growth rate over the next 5 years from all of my positions. So a 26% growth assumption for Mastercard gives me a lot of margin room for error. And of course, I'll take all the icing on top of the 10% this stock may offer. Up next, we have Charles Schwab, ticker symbol SCHW. Schwab has seen revenue growth of 13.21% during the past decade, with 9 out of 10 years seeing growth. Earnings per share also look quite nice, with a long-term growth rate of 14.84%. Schwab pays an annual dividend of 72 cents. That equates to about a 1% dividend yield. While this yield is also very low, it is double Mastercard's yield. Schwab has not yet increased its dividend in 2021, and investors saw a rather low increase in 2020 of 5.88%. The 5-year dividend growth rate clocks in above 20%. This, coupled with a very low payout ratio of about 20%, leaves plenty of room for a nice dividend hike in Q4 of this year. The Q4 dividend should be announced in late October, so we should know in about a month or so. Historically, Schwab's dividend yield has oscillated between as low as 0.5% and on occasion above 2%. The current dividend yield of 1% is the worst yield the stock has offered to investors in the past 2 years or so. However, long-term investors would have a yield on cost of about 6.2% during the past decade. Schwab is having an excellent year, as the share price is up 38.47% year-to-date through month-end August. During the past 3 years, it has a 14.48% annualized return, and an even better 19.74% return during the past 5 years. Based on dividend yield theory, Schwab looks to be 3.7% overvalued right now. But even with this slight overvaluation, I think the stock is poised to reward investors with strong returns. Analysts are forecasting 21.15% EPS growth for Schwab over the next 5 years. If we assume the share price will follow the same growth trajectory, and we adjust for the overvaluation and the current dividend yield, we come up with an expected annual growth rate of 21.42%. And dividend growth stock number 3 is Nvidia, ticker symbol NVDA. Nvidia pays a 16-cent annual dividend, giving them a 0.07% current dividend yield. This barely quantifies this stock as a dividend growth stock, but it is one, and I think in 10 or 20 years, Nvidia will offer a very strong yield on cost, as well as have strong double-digit total returns. Revenue has grown at a rate of 19.43% during the past decade, and earnings per share at an even quicker rate of 28.69% per year. Dividend growth has been a little weak, with the 5-year dividend growth rate sitting just north of 10%. Historically, Nvidia has offered much more attractive dividend yields of 2%, but since about 2014, the yield has been falling quickly as the share price has climbed and dividend growth has not kept up pace. Nvidia has a 10-year yield on cost of about 4.4%, which is pretty decent. It also has a very, very low payout ratio of less than 5%, so there definitely is room for faster dividend growth. Ultimately, it is up to the management of the company to determine how excess funds will best benefit shareholders. Since the company is still growing quickly, it may be beneficial to give shareholders smaller dividend raises and invest more capital back into the business. I think at some point the dividend increases will become larger. How far out in the future that point is hard to tell. I personally am willing to wait, but I could see how many dividend investors would not. Nvidia is a very good growth stock, but it is certainly not for all dividend investors. 2021 is a very strong year for Nvidia, as the stock is up 71.59% through month-end August. During the last 3 years, the stock has an annualized return of 47.57%, and during the last 5 years, the annualized return is an amazing 71.44%. Based on dividend yield theory, Nvidia looks to be 75.09% overvalued right now. But even with this major overvaluation, I think the stock is poised to reward investors with strong returns. Analysts are forecasting 32.6% EPS growth for Nvidia over the next 5 years. If we assume the share price will follow the same growth trajectory, and we adjust for the overvaluation and the current dividend yield, we come up with an expected annual growth rate of 20.82%. So each one of these dividend stocks is poised to reward patient investors with 20% plus per year returns during the next 5 years. Obviously, there is no guarantee this will happen, but there is a higher chance that combined all 3 companies can hit that mark. I like to invest in companies from my watchlist that have an expected future return of 10% or more. I'll be sharing all of these companies with you here 3 at a time, so make sure to come back if you want to see which other dividend stocks are poised for strong growth in the future. Thank you for watching, don't forget to subscribe, and see you next time.